Welcome to today's class, and today's lecture is on market trends and direction. So again, like I said, we're getting into more technical things in trading now. Again, this is still theoretical, but it's more technical in that these are things that you actually need to understand them to trade in the market. So the knowledge of these things from types of traders, orders execution, other types, the knowledge of those ones are very, very, very essential. Topics like participants in the market, you may not necessarily know, and the truth is, for a fact, nobody really knows all the participants. We are all not sure. There's data to show who is participating and who isn't, but we don't really know the influence of this or that. We just know because the forex market is not centralized, it's decentralized. So the extent to participation in the forex market is not a concrete facts, we don't really know. So, but welcome to this class. Today's topic is market trends and direction. So, what is a market trend? So, a trend is the general direction in which price moves over a specific period of time. So, when prices keep rising, the market is said to be bullish or uptrend. Okay, so I want you to take note of those terminologies. That is bullish uptrend. So, when the market keeps rising, so when the market is going up, when the market is going higher and higher upwards, it's said to be bullish or uptrend. So most people have seen a forex chart before, but may not be able to interpret it. It's the same thing you see. I think in the hospital, the graph. Most people see forex charts and say, "Oh, what's this graph?" So, anyways, when you see any graph that is going up from the left to the right, it is going higher and higher. That is called a bullish market or an uptrend. It may not be a market, it may be representing a variety of things. When prices keep falling, the market is said to be bearish or downtrend. Now, just quickly explain why bullish and why bearish. So it's said to be bullish because a bull, so now this is using a bull as reference. So a bull is an animal such that if you've ever observed bullfighting or bulls interaction with humans or other bulls, whenever they want to attack, a bull tends to put his head down, then push higher. So a bull will put its head down, then raise its object, so its opponents higher. So a bull would dip its head down, then push higher. So that's why it is synonymous with bulls, because a bull will go down, then push up. So bulls generally throw things up. They generally throw their challenge, their oppositions up. So that's what bulls do. A bear, on the other hand, will pounce on its prey. A bear will pounce on its prey. It would come from up, then pounce on it downwards, then begin to probably kill it and then eat it. So that is the reference to bullish and bearish. So bull, it pushes it higher. A bear will pounce and press its prey downwards. I hope that explains the reference to you. So when prices move sideways, because yes, there are times when you can't really tell where the price is going. So when prices move sideways, it is called a ranging or a consolidating market. So just a consolidation, something that doesn't have a specific direction, just up and down, up and down. Recognizing trends helps traders, one, enter in the direction of momentum, which is very important. Avoid trading against the market flow, which is very important. Identifying potential reversals early. So let me talk about avoiding trades against the market flow. You see, when I think it's the salmon fish that swims against the tides and then gets to the bank and dies. It's if there is a natural flow existing, usually it's counterintuitive to go against the natural flow. If you have nature, you have forces of the market or anything that helps you go in a certain direction, it just makes sense to follow the flow of things. And if you want to go counter direction, it's usually expected to be cautious or to wait because nature and the world operates in tides. We live in a world that operates in up and down, in and out, on and cold. We live in a sort of dualistic appearance of life. Everything has a up, a down, a in and out, a crest and a throw. Like it, there is always an ebb and a flow to. There's a rhythm to the way the world works. So there is a flow to the affairs of nature. So that being said, it's always best to follow the naturally occurring trend. So we have market trends and direction. So again, let me just use this as so we have these animals, the bull and bear. These terms come from the way each each animal attacks. A bull attacks by thrusting its on upwards, symbolizing rising prices. A bear attacks by sweeping its paws downward and symbolizing falling prices. So a bullish trader expect prices to go up. A bearish trader expect prices to go down. So I hope that's clear. So what uptrend, bullish, long, and buy. So this usually is technically around, it explains the same thing. So uptrend symbolizes a bullish market, and that can also be synonymous with a long market. You can also call it a buy market. So technically, these are just terminologies to signify that the market is going up. So what does it mean to go long? To go long, bullish, buy, and uptrend all mean the same thing. You can buy a currency pair its value to expecting its value to increase. So e.g., if you buy Euro USD at 1.0800, expecting it to rise to 1.0900. If it does this, you profit from the rise. So being long is equals to being bullish, is equals to being uptrend. So downtrend, bearish, short, and sell. So again, we have uptrend, downtrend, bullish, bearish, short, and long, sell and buy all mean the same thing. So downtrend is the same thing as bearish, is the same thing as short, is the same thing as sell. So short and sell are mostly used when you are actually taking a trade, executing an order. So you say short the market or sell the market. But downtrend and bearish are usually used to describe the nature or the trend of the current market. But you can always use everything interchangeably. So what does it mean to go short? To go short, bearish, sell, downtrend all indicate a drop in the market price. So that means from the left side to the right side, the market is going down. So you sell a currency pair expecting its value to decrease. Example is selling pound USD at 1.2700, expecting it to fall to 1.2600. So if it does this, you profit from the drop. So being short is equals to being bearish. Remember, when you sell the currency pair pound USD, you are indirectly buying USD. You're expecting the value of USD to go higher because that is the only reason why the pound will drop. If the pound is dropping, the value of its pair, its quote currency, is going to be stronger in that pair. So ranging, sideways, or consolidation market. So a sideways trend, also called a range or a consolidation, occurs when price fluctuates between two horizontal levels. So we have a resistance level, which is the top of the range, where price repeatedly falls to break higher. Where price repeatedly fails to break higher, then we have a support, which is the bottom range, where price repeatedly fails to break lower. So there's a sort of a ceiling and a floor. There is sort of a constriction. It can't go higher, it can't go lower. It's just up and down, up and down. You don't really know where price is going. So this is called a ranging market, a sideways market, or a consolidation market. In this condition, the market is thought to be neutral, neither bullish nor bearish. So we have market analysis. So there are generally three types of market analysis. We have the technical analysis. Technical analysis is the study of price movements using charts, patterns, indicators to predict market direction. So technical analysis is used to predict future markets with with what we can see on the charts, with some indicators. So this is what technical analysis is all about. It's based on the idea that price action reveals everything. So that's the idea with technical analysis, that price action is basically what you see on your charts. So the candlesticks in relation to maybe a line, indicators, all of that is price action. So the idea of technical analysis is that there is a repeatable pattern that you can observe and then use that as a an edge to make money from the market. So meaning all available information, which is the economic, remember the economic calendar in the previous lecture. So which means the economic, the political, emotional is all reflected in price. So core principles of technical analysis is price reflects all information, which is the news, expectations, and emotions are all built into price. So also it it states another principle is price moves in trend. So market tends to move in recognizable directions up, down, or sideways. Also, history repeats itself. Human behavior in markets is cyclical, so past patterns can reappear. Common tools used in technical analysis are one, charts, which is used to visually represent price action. You can have the line chart, the bar chart, or the candlesticks. We have indicators like the moving average, the RSI, the MACD, the Bollinger Bands. We have patterns, which is head and shoulder patterns, triangle, double top patterns, resistance and support levels. All of those things will become understandable later. So resistance and support levels are key price zones where buying and selling pressure usually builds up. So again, a technical analysis is a method of analyzing and predicting stock or price movements based on past market data, primarily price and volume. So that's what a technical analysis is about. We have fundamental analysis. So this is the study of economic, financial, and political factors that influence a currency's value. So it's called fundamental because it's the idea is that everything is really based on these things. Everything that every movement of price is based on these basic things, which are the fundamentals of an economy. The financials, the political factors, the news. These things are regarded as fundamentals. So we have people who analyze these fundamentals to predict market prices. So fundamentals answer the why behind price moves. Its idea is that these are the main reasons why anything really happens, why money flows, why business occurs, why political events are happening. So this is the why of price movements. So core drivers are one, interest rates. Higher interest rates attract investors, which leads to a stronger currency. Inflation and growth. So rising inflation or strong GDP can move central banks to act. So the inflation rate usually is where the central bank comes in to lower the inflation rate with usually they do this with the interest rate. So lower inflation and increase inflation just to ensure that there is a balance in the economy. So we have employment data. For instance, we have the United States non-farm payroll, which can shift market sentiment very quickly. So this non-farm payroll is the payroll of all employers, all employers in the US. The average, of course, is not everybody aside the non-farm sector. So basically, this gauges if there is an increase. It just kind of gives an idea of how the economy is doing. So that's what non-farm payroll is all about. So we have central banks. So we have central bank policy statements like the Federal Reserve or CBN can have massive impacts. Monetary reports, fiscal policies, all of these things are very essential to fundamental analysis. We have geopolitical events, election wars, crises. All of these affect confidence and risk appetite. Remember risk appetite, remember safe haven currency. So when things are happening in a certain country or affecting a certain currency, the very wealthy people in that currency or investors in that country tend to move their money somewhere. And if they are not exactly going to use it to do business or anything, they tend to move it into a safer currency. Sometimes this may be the JPY, that's Japanese yen, maybe Swiss franc, it may be the US dollar in some cases, and it may be gold, it may be some other currencies, the Omani, Dinar, and all of those that we mentioned previously. So how traders use fundamental analysis? So you can use it by monitoring the economic calendar, Forex factory in this case that we mentioned. So we can trade after news releases, combine both technical and fundamental setups to confirm entries. Remember the scenario we mentioned about a swing trader. So it usually combines a little bit of fundamentals with a little bit of technicals, as opposed to the scalper and the day trader who may rely solely on technicals. We also have the sentimental analysis. So sentiment is analyzing the mood of market participants. Are they bullish? Are they bearish? Just a feel what's happening. So sentiments can come from a variety of things. It can come from a price level on the chart. It can come from the fundamentals, from geopolitical events. Just feeling that people will be scared. People will be scared. People will be excited. Most people want to buy this market. Most people want to sell. Just coming to a conclusion of that. So it helps traders avoid trading or trade against the market's flow. Sometimes it encourages you to trade against the market flow. When everybody is excited, it's sometimes a very good time to exit the market because yeah. The sources of sentiment analysis is commitment of traders reports. So this shows institutional positioning and it gives you an idea of where the large institutions are positioning their trades. And because it's a public information, people can follow this data. So we have news and social media. So this can gauge crowd optimism of fear and greed. So there's a fear and greed index in most markets, in the stock market, in the crypto market. Just gives you an idea of how people are feeling towards a certain market. So we have price action. So strong trends often reveal dominant trends. So if the market is going higher and higher and higher, it really means that people are buying. People, a lot of people are buying. There are more buyers and than there are sellers, and it's natural when there's more demand than supply. You expect the prices of the commodity to continually increase until the demand drops and the supply increases. For example, if traders are overwhelmingly bullish on gold, but price starts falling, it could indicate that the market is overbought, a potential reversal signal. So if the price is going higher and higher and higher and higher, and then suddenly you just see sharp drops, it may just mean that no one is buying again. People are scared of buying. It has reached maximum greed. So it can indicate that it has reached maximum grid and now fear is kicking into the market, which is a potential reversal signal. So how to use it? One, they use it as a confirmation tool alongside its technical and fundamental setups. We have market structure. So market structure refers to how prices move in sequence of higher highs, higher lows, lower highs, and lower lows that form trends. So it is the language of price action, the map that helps you know where you are in the market direction. So core concept, one we have the uptrend or the bullish structure. Now in this case, remember uptrend, bullish market. So this is also the same thing, something that is going higher. So in this case, we have something called a bullish market structure. So this is a combination of a higher high and a higher low. So not to complicate it, this is just when the market is going higher and higher. And you will easily identify this in the price chart. So we have higher high and higher low, higher and higher low. So this indicates that buyers are in control. Each new high is higher than the last. For example, Euro USD moves from 1.0800 to 1.100 and then it moves to 1.200. So this indicates that the market is going higher and there's some excitement, some greed, some buying pressure, some demand of that asset. So downtrend is a combination of a lower high and a lower low. So in this case, it indicates that sellers are in control and each new low is lower than the last low. So we have a sideways or the range structure. So this is usually identified by seeing relatively equal highs and equal lows. So they are neither buyers nor sellers. Remember the explanation of the consolidating or the ranging market or the sideways market. So there's neither buyers nor sellers dominating. Price oscillates between up and down. It oscillates between a support, a ceiling, and a resistance. So why it matters? It helps traders identify the current phase of the market. So trending market best for momentum strategies. So that's when the market is going in uptrend, higher high, higher low, higher high, higher low. It could be downtrend too, lower high, lower lows. So this is good for momentum trading. So ranging market is good for reversals and scalping. So generally, it is believed that when the market begins to range, it is about to change the direction. So this may be an indication for contrarian traders, which is traders that go against the trend to prepare to take their sales. So it may also be a possible reversal zone, which is a transition zones, either to retrace the market, which is slightly come back into a current trend, or reverse completely and change the direction. So let's talk more about the bullish trend. So a bullish market, also called an uptrend, occurs when price consistently forms higher highs and higher lows, as you can see in the picture on the right. So this is higher high, higher low, higher high, higher low. Again, it's just good to understand these things. Now, the moment you begin to see a price chart, the moment you lay your eyes on a price chart, and I'm assuming most of you have seen a price chart before, but I'm keeping this as theoretical as possible. I'm trying not to show you any price chart because there is a knowledge side to learning how to trade. There is actually a core knowledge side to it, and this is what I'm trying to bring to you. A core knowledge side to it, like has absolutely nothing to do with price. Understanding it as a topic of itself, not technical analysis. No, no, no. It's very important for you to understand it like this. Most people say, I just want to make money. Very quickly, you would find out eventually that making money is not the most important thing here. Very quickly, you realize that it's better for you to know some of these things and understand it and digest it. And yeah, so a bullish structure means that buyers are in control. Each wave is stronger than the last. So the pattern of the structure is high, high, and higher, low, higher, high, and higher, low. The psychology behind it is that buyers dominate. They are willing to pay higher prices for the markets or the commodity. So it's high, but they're willing to pay higher. So it will go higher. It may come down a little bit, but then people will pay even higher price, and then it keeps going higher. So sellers attempt to push the price down but are overpowered by the buyers. Remember the example of the supply and demand. So there may be supply in the market, but the demand is higher. So the price will naturally go up because more people are willing to buy. So the price will keep increasing. So there's confidence and optimism, and this drives the trend of that market. So what traders do, one is look for buy opportunities, long trades or buy trades. they look for this near the higher lows. So when the market comes down a little bit, because it's an uptrend, you're expecting it to go higher. So if you're expecting the price to go higher and then it comes down a little bit, shouldn't fear. There should be no reason to fear. You should just be interested to buy in that market because most likely it's going to keep buying because there is a trend. So they also use this as pullbacks for entry in the long direction. Again, that is a pullback is the between the higher high and the higher low. That is a pullback. That slight downward movement is called a pullback, and most traders try to target an entry between there and go higher. So the key tip here is never chase. Wait for retracement entries within the uptrend. So you don't have to enter because it's a bullish. You shouldn't just enter anywhere. Wait for a little bit of retracement and then participate in the long market. So we have the downtrend, just the flip side of the uptrend. A bearish market or a downtrend occurs when price forms lower highs and lower lows. Sellers dominate. Each new low breaks the previous one. The structure is lower high, lower low, lower high, and lower low. The psychology behind it, sellers control price direction. Buyers attempt recovery. They attempt to buy. And this is where you see the pullbacks, but fail to create new highs. So there's fear and pessimism driving sales. So anywhere there is a downtrend, anywhere there is a sale of an asset, it means that people are not excited about that asset or currency or commodity, and that usually indicates fear. So what traders do one is look for opportunities near lower highs and then sell, and they also avoid buying into a falling market unless for short-term scalps. Again, scalpers can afford to do this because the nature of their trade allows for very short-term trading. Avoid buying into falling market. The descriptions this is avoiding to catch a falling knife. So it doesn't make sense to a knife is falling and you're trying to catch it with bare hand. So that's the description here for avoiding to buy into a falling market. So the key tip here is in a downtrend, rallies are opportunities to sell, not a signal or reversal until the structure shifts. We have the sideways, the ranging, the consolidation. A sideways market occurs when price moves between horizontal support and resistance levels. Neither buyers nor sellers dominate. It's a period of balance or indecision. The structure is equal highs and equal lows. Price oscillates within a box. It's not going to be perfect, but it's just an idea. You can visually identify that the price is just going higher and lower and higher and lower within a range. It's not going anywhere. Psychology behind it is that the market is resting or waiting for new information. Also, it may mean that traders are indecisive. The volume and volatility often decline in this scenario. Also, institutional players often accumulate, buying quietly or distribute, sell quietly in this phase. So this is a stage where a lot may be happening or a lot may not be happening. It's just a stage where a news is about to come out, some world leader is about to speak. So people don't know. So everyone has taken their money out of the markets just to watch what's happening. So when the news is dropped, now the new direction is formed, then people can now participate, knowing fully well that okay, look, this is the decision of this world leader, this is what the news says, okay. This is then they can interpret that news to participate in the market. So what traders do here is range traders buy at support and sell at resistance. Trend traders wait for a breakout before entering, and breakout traders watch for volume surge beyond the range boundaries. So range traders are people who can buy and sell within this up and down trend within this range. So when it goes higher, they will sell. When it goes lower, they will buy. Best for scalpers. Trend traders wait for when it breaks that range. You see a visible range and then it goes above it or goes below it, and then you participate in that movement. So breakout traders or technically it's almost the same thing as trend traders. But in this case, if the market is selling, then it consolidates. So breakout is where the market just keeps going down, and that's a breakout. So it just keeps going down in that range. So but trend traders usually wait for a new trend to form. It forms a new trend. Okay, now they identify that it's an uptrend or it's a downtrend, and then they participate. So the key tip here is sideways markets often precede major breakouts. So patience pays. If you are not a range trader, it is not actually advised to participate. Not a range trader, not a scalper. It's not advised to participate in this market. Okay, so that brings us to the end of today's lecture. I hope you enjoyed it. As you can see, I spoke a lot about upwards markets, downwards markets, sideways markets, and used so many ways to try to help you understand. I explained its structure, I explained its analysis, I explained it in trend because this is the core. This is something we now actually need to understand. Market is going up, market is going down. This is important technically. It's a very relevant information. Okay, is it going up, is it going down, is it this is where you start to understand it. So your basic understanding of this thing, that there's an upward market, there's a downward market, is very, 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 very important. I hope I've been able to, like, because I try to repeat these things as much as possible. Uh, don't get bored of this. It is understand that if someone who if someone who knows something is hammering on a point, remember I think in the previous lecture I hammered on self-awareness, self-awareness, self-awareness. Now these topics are things that eventually you would, not now. I don't even expect anyone to appreciate this now, but eventually you would, 1 year, 6 months, maybe 5 years down, you would now understand. Oh, this is why. So I hope you can trust and understand, and you won't understand. So I just hope you can trust my persistence and reiteration of some of these topics now, because they're very essential. They're very important for you to understand, and I'm doing this to give the best of myself. These are things I wish I understood in the very beginning. I feel like if you watch this series of these videos and complete and understand them, it will take pretty much a lot of time off the learning phase, because some of these things, I didn't understand them until later. Some even after a year or 2 years, I didn't understand them until later. So again, I am not going to add any. There's so much fluff you would learn if you watched other videos, or if you read PVPs or something. I'm not going to add any of that. I'm not going to talk about so many things. I'm just like, these ones are just important stuff that are very necessary. I know within my heart that at some point in the future, after you've seen this video, you come to appreciate it for its core topics, the specificness of these topics, not being too broad or just talking about everything. So again, I'm deliberately keeping it theoretical because I want you to understand these things on a theoretical level. That's why I keep telling you to grab a notebook and a pen, just take notes, just try to understand it. This is what this means, this is what that means. And I hope at some point all of this turns into value for you, and you make a decision on what you want to do with this information, and hopefully you can profit from the markets at some point in the future. So with that said, I wish you a wonderful day, and I hope you have the best of your day and the best of your activities. And until the next lecture, I wish you all peace and good luck.